Hello, everyone. This is the Harvard study case of American Barrick Resources by Colin, Ragad, John, and Andrea. Today, we'll be talking about American Barrick Resources Corporation and its strategy to minimize its risk in the gold market and in the gold mining industry. Please take a moment to look over the table of contents and the topics that we'll be talking about today. Let's jump right in. This is American Barrick Resources Corporation. It was founded in 1983. It's headquartered in Toronto. The founder and CEO is Peter Monk. The industry that the company works in is metals and mining. The market cap in 1992 reached 5 billion towards the end of the year. Its business model, according to the website, is we strive to be the world's most valued gold mining business by finding, developing, and owning the best assets with the best people to deliver sustainable returns for our owners and partners. Here's a brief history of American Barrick Corporation. It acquired gold mines for lower prices when gold was in the slump in the mid 1980s. It has mining operations around the world, with 75% of its production from the Americas region. During the early 90s, many of its shareholders were non-traditional investors, meaning that they were seeking quick growth and profit instead of the value of the underlying asset. American Barrick Corporation is the incumbent of its industry and is a master of gold price risk management through hedging and debt minimization. The founder of ABX is Peter Monk. He's a successful Canadian entrepreneur and financier. He had no prior experience in the gold mining business prior to beginning ABX, but he did think that there was a desire in the market to invest in a stable gold producer that wasn't involved in political turmoil in the South African region. Here we see Monk's motivation behind hedging and the answer to question number 2 of our study case. Monk's conservative financial values were created from an earlier failed business in which Monk came to distrust highly leveraged positions. He continuously emphasized a strong liquid balance sheet. Our financial strength not only ensures our existing development plans, it will allow us to take advantage of the decade's opportunities. Don't go to sleep on me yet. In this slide, we'll see the industry basics and the gold mining value chain, which consists of four separate phases: exploration, acquisition, develop, mine, process, and the sale of gold. Please take a moment to read over the slide. In this slide, we get introduced to the first question of the case study. ABX's success and competitive advantage arises from the acquisition phase of the value chain. ABX acquired gold mines with superior production rates, previously unknown reserves, and most importantly, a skilled technical and engineering staff. Key staff like Robert Smith, President and COO. Here's an overview of American Barrick financing programs. Barrick Coolton Gold Trust, bullion loans, and gold index notes. Let's begin with Barrick Coolton Gold Trust. In 1983, ABX funded the purchase of Reneby Gold Mine by issuing common shares. For additional capital, ABX created the Barrick Coolton Gold Trust. It was the first publicly traded gold royalty trust in Canada. It paid investors 3% of mines output when prices were $399 or less, and it paid 10% when gold was at $1,000 per ounce. Next, we see bullion loans. To fund the Mercer mine purchase in 1985, ABX used bullion loans to receive 77,000 ounces of gold to sell for $25 million. The loan was paid over the following 4.5 years in monthly installments of gold ounces at a 2% interest rate. American Barrick utilized its mining assets as collateral for some of these loans. The same type of loans were used for the acquisition of Gold Strike Mine and its properties. ABX has gold loans promised through 1997. ABX also offered gold index notes in 1987 in the tune of 50 million with a rate of 2% to European investors. The majority of the investors were EU fund managers and paid about $1,300 per note. Gold index notes can be redeemed any time in a given period. The more the investor waits, the higher the amount they will receive in cash or in gold bullion. In this slide, we see the overview of American Barrick hedging programs and the answer to question number 3 of our study case. They used forward sales, option and warrants, and spot deferred contracts. Let's take a look at forward sales. During the drop in gold prices in 1984 and in 1985, American Barrick started forward sales hedging. The primary goal of using forward contracts is to mitigate the down risk of gold prices. With forward contracts, ABX protected themselves from future price declines. ABX was committed to deliver an agreed upon quantity of gold at a specific future date at a specific price. However, ABX lost the upside potential when gold prices increased and missed the opportunity to sell at higher prices. Next, we see options and warrants. Options gave ABX the ability to capitalize on the price increase and minimize the downside. ABX benefited from the collar strategy by selling call options at a higher prices and using the premiums to purchase put options. This approach was appealing and it required no cash outlays. The disadvantage of this was the short-term nature of options. They had 20 years worth of production in reserve, meaning they wanted to find something with longer term conditions. As a result, they stopped using this method in 1990. The next topic of our discussion are spot deferred contracts. SDC is a forward sale of gold with multiple delivery dates, with the final delivery date in the upwards of 5 to 10 years. The seller of the SDC chooses which date it will deliver the gold on, knowing if it chooses to continually roll the date back, they will pay the price of the contract plus a premium. SDC gave ABX the ability to profit from price increases in gold, and it allowed them to set prices on its reserves. SDC effectiveness. In a standard forward agreement, the delivery date is set. The seller delivers the commodity at prearranged time and price. The advantage of the SEC is that Barrick could hold off in delivering gold for its future contracts if it could sell the higher on the open market. However, this was effective during price volatility. If the spot price of gold was steadily increasing, then they would not gain an advantage in delaying future contract deliveries to sell on the open market. By waiting to deliver the SDC, they would be missing out on even more profit since the price of gold was rising. Now let's get into the bigger picture and the answers to questions 5 and 6. The performance of American Barrick. In 1992, ABX produced over 1 million ounces of gold and sold it for a price that was higher than the market price by about 22%. From 1983 to 1992, ABX equity market capitalization grew from 46 million to about 5 billion. In the same time frame, Barrick's gold production grew from 34,000 to over 1 million ounces annually. At the end of this time frame, it was Canada's eighth largest publicly traded company. Was American Barrick's top performance luck or skill? Will it be repeated? Well, I think it was both. It was They had a lot of luck with discovering gold and previously untapped reserves, and they also had luck in the timing for their acquisitions. The skill part came in the hedging programs, the acquisitions, and the resource exploration. Barrick can improve their chances for success by hedging appropriately, but a big part of their business still depends on the spot price of gold and new gold discoveries. Effective hedging program. Hedging is not just for volatile times. Risk always exists in markets. Barrick should not rely on the short-term monotonic pattern in deciding to scale back its risk management program. You may ask yourself why companies hedge. Well, firms hedge for several reasons: tax benefits, protecting against catastrophic risk, reducing underinvestment problems, minimizing risk exposure, and it looks attractive for investors. Now for the $0.8 million question, or ounces. What should we do with a .8 million ounce windfall? Well, for a company like American Barrick, who has shareholders that believe in the style of business that Barrick brings to the market, we have decided to continue the same hedging practices of gold production. They may have changed up the style of hedging or try to combine the styles to keep creative, but this strategy has worked for them for 11 years, and we believe that it will continue to work. By continuing to hedge, Barrick can lock in profits and sustain growth. The following are the reasons why we decided to go with the hedge, the windfall. Analysts disagree about whether the price of gold will increase. Worldwide, some gold mines are slowing production and are unprofitable at current prices. There is uncertainty about the future price of gold. but the price is currently at historical low rates. Barrick does not want to lock in low rates through a forward contract, and SDCs would depend on volatility. The primary hedging strategy for the windfall would be to buy put options and insurance. We will buy put options to give ourselves a floor at which to sell a portion of the gold, and we'll get insurance in case the price of gold fell significantly. Secondary hedging strategies for the windfall would be to sell call options and offer spot deferred contracts. By selling calls now, Barrick will have immediate working capital. This is similar to the collar strategy, but we will reduce the selling calls so that possible profits are taken advantage of in the upward price trend. Also, Barrick should not go as heavy on SDCs as they previously had given the current low spot price, but having a small number of these contracts could be a good guard against volatility. This concludes our presentation. If you have any questions, please feel free to contact us.